Hi, good afternoon. Counting down to RBI policy, and you're watching ETNA's special coverage with me, Aisha Faridi. I've got my colleague Ruchi Bhatia as well joining in. Very quickly, a take on what the market is up to as we step into policy day. A listless start, and then it's picked up quite smartly. In fact, we're just nudging that 11,200 level in the Nifty right now. The breath is looking strong, although it's ebbed off just that wee bit from where we started off in trade. But nonetheless, it is advantage greens, and it is the advances which are actually taking over. But all eyes now on the policy. Within minutes from now, we should be hearing the policy announcement. It's coming at a interesting context right now, considering that growth continues to remain weak. India's unlocking has been slow, and the central bank's own prognosis has been indicating rising asset quality stress as well. So growth revival, it seems that at least that's the broad consensus on the street. Growth revival should be the policy focus. That is what the street continues to maintain. While we've got a pretty split and divided poll, I'll get back to my colleague Poonam Sani as well in just a bit and get in a sense of what the market participants as well as economists are penciling in as we step into the policy, because it seems like it's a divided house, and whether or not it's going to be a status quo or is there going to be some easing by way of rates. But the headline inflation as well, while it's currently above RBI's projected trajectory, has probably peaked out. So that is something which is aiding the central bank policy move or prognosis this time around. Also, perhaps the RBI should maybe this time around overlook or look through the temporary spike in inflation, as it is just being driven by COVID-19 related supply disruptions rather than, strong pricing power or wages which are actually worsening. So, Ruchi, the stage is set and the street is pretty divided. Don't know which way the MPC is going to tilt this time.
Oh, absolutely, Aisha. In fact, the last two monetary policy meetings that we saw that were convened, in fact, ahead of schedule, effected large rate cuts in the policy. But it seems that perhaps this time around the outcome could be a little less dramatic. There's no overwhelming reason, if one should put it like that, to steer the policy in any particular direction at this point of time. Well, yes, growth has improved. We're way past the lows that we saw in the month of April. There is good news on the economic front, because most economic indicators have are now starting to move upwards from the troughs that we saw in the month of April 2020. However, as you rightly pointed out, inflation has flared up, and is that something that the RBI will be looking at very closely, something that we need to watch out for. Of course, the House is also divided, because one is waiting to hear from the RBI on whether they will be holding their fire for perhaps a later stage. That's when there is a need to give a greater push to economic activity, to growth, and of course the commentary coming in on what happens to the issue of loan moratoriums, and or if there's going to be a one-time loan recast. We're of course waiting for the RBI governor. He will be addressing the press at noon today. But before that, let me take it across to my colleague Poonam Sani. She's also standing by with more details. Poonam, what are the expectations that various economists are penciling in?
Well, it's likely to be a close call in terms of the RBI repo rate cut. Well, 46% of the economists do expect RBI to cut the repo rate by 25 bips, but close to around 54% expect RBI to still maintain a status quo, as RBI has front-loaded repo rate cut. Reverse repo rate cut expectations are high, close to around 54% expect 10 to 25 bips cut, and 23% expect a cut of 35 bips on the reverse repo front. CRR may be retained, and also a accommodative stance may be maintained. In fact, the rationale for a repo rate cut is growth still remains fairly fragile. We're also seeing that demand side weakness is outweighing supply side disruptions, and hence the economy does need the monetary policy support. Having said that, RBI has front-loaded the rate cuts, and maybe RBI may want to pause this time before further cutting the rates. In fact, RBI may widen the policy corridor further and may disencourage banks in order to park the funds in the reverse repo window, so that banks should in fact be lending more to the economy, and hence more reverse repo cut may be seen. Having said that, RBI's commentary in terms of the growth and overall demand weakness would be fairly important. Commentary in terms of the negative real interest rates and liquidity, and also bankers have asked RBI not to extend the moratorium, and hence what are the possible options that RBI is looking at, and the commentary in terms of fiscal stimulus will be important.
Counting down to the policy. In fact, all eyes now on the RBI Governor, who promised that it's going to be whatever it takes to shield the Indian economy from the COVID pandemic. In fact, experts have been suggesting the central bank is done with the rate cuts for now, but loan moratorium, whether that's going to be extended, that's a very key question which is on everyone's mind. And will the RBI really consider a demand of one-time loan restructuring or not? In fact, we at ET Now put together this special report. Take a look.
Need of the hour is to do whatever is necessary to shield the domestic economy from the pandemic.
Bankers and markets took heart from these comments made by RBI Governor and his whatever it takes approach in March, when India's COVID-19 nightmare had just started to unfold. Cut to 5 months and 115 basis points cut later, a long list of challenges and demands is staring at India's central bank as it unveils its monetary policy on the 6th of August. MPC is deliberating at a time when it is faced with key burning questions on extension of loan moratorium scheme, one-time restructuring of loans, rising inflation, and a possible massive surge in bad loans. RBI's Financial Stability Report expects gross NPAs to jump from 8.5% in March 2020 to 14.7% in March 2021.
Please do not extend the moratorium, because we see that even people who have ability to pay, whether it's individuals or corporates, are taking advantage under this moratorium and deferring payment.
Top bankers are vehemently opposing any extension of loan moratorium scheme, the deadline for which is August 31st. Deepak Parekh points out that a blanket moratorium means even the borrowers who can afford to pay will take undue advantage of the scheme, resulting in choking the fund inflow for banks, which will hurt NBFCs the most. Meanwhile, Uday Kotak and other ace bankers suggest the pill of one-time loan restructuring so that banks can be better prepared for tomorrow.
There is a growing view across the membership of a need for a one-time restructuring. And I just wanted to present this to you as a broader request across the membership of CII as well.
All eyes are on the stance RBI will take on the contentious issues of moratorium and loan recast in its commentary after the policy announcement. Front-loading the measures in March to deal with COVID-19, Governor Das introduced several steps like slashing CRR by 1%, undertaking LTROs, ease of working capital financing, etc. These measures were pegged to inject liquidity worth 3.2% of GDP into the banking system. 2 off-cycle steep rate cuts of 75 and 40 basis points by the central bank in March and May 2020 brought India's repo rate at its historic low of 4%. But is it enough to move the needle? Governor Das promised he will do all it takes to shield the Indian economy. It remains to be seen how far will he go to keep his word. With Dimple Sharma, Chandra Ashrikant, ET Now.
Okay, counting down to the policy, I just want to quickly get a status check on what the markets are up to. Actually, we're holding steady right now. We had a listless start, but we've picked up since then. In fact, we are just less than 20 points shy of that 11,200 mark. So the headline number is not really giving you any causes of complaint. Yes, sure enough, today is a mid-cap day. We're seeing better traction and action within the broader universe with names like Tata Consumer, NIT Technologies, Z, Aurobindo Pharma, REC. These are stocks stocks which are looking buoyant in the markets. The Nifty is fairly placid. Some of those technology names are holding out. You've got an Asian Paints and Britannia, which is holding out. On the flip side, it's a bit of a tug of war with some of the banks as well as auto names, which are looking a tad bit weak. Let's welcome on board two more ladies then. We've got Sonal Verma from Nomura India joining in, and we've got Etina consulting editor Maithili Busnirmat as well joining in. Ladies, afternoon. Maithili, let me come to you. I guess more than what the MPC chooses to do on rates, it's going to be about moratorium. I think all eyes are on that piece of news.
Yeah, well, really, the action lies in the non-interest rate actions, because that's what we're looking for, not just in moratorium, but there are various other things that the RBI can do in terms of forbearances in case of treasury profits, the quantum that is held to maturity, etc. So there are, again, in terms of the NPA definition, so many things that the RBI can do, one-term restructuring. So these are things that lie outside the MPC's domain. So that, I think, would be of interest. Another thing that would be of interest, Aisha, is also to see whether the RBI will finally commit itself in terms of GDP growth. Because so far, I think the governor had not been mentioning any number. Of course, it's very difficult to give a number in these times. But on the GDP front, whether there's any greater degree of certainty, if one can use that word at all, I think these are the two things that one will watch out for. Rate action, I think, generally speaking, the feeling is that there's really no case, not only just because of inflation, but also because monetary policy is really not serving any purpose. So at the moment, I think the attention should shift to the non-interest rate action and also, of course, to the commentary from the governor.
Yeah, absolutely. Abhik Barua, hi, morning. What are your expectations from the policy? Do you think something material will come on the moratorium status, or at least some clarity, or for that matter on loan recast? I guess just about everyone's focusing more on that as opposed to the policy per se or rates per se.
Well, I just hope so, because as Maithili pointed out, the interest rate policy or strategy would be a bit of a sideshow. It doesn't really matter whether they cut the repo rate by 25 basis points or the reverse repo rate by 25 to induce banks to lend more. It's really issues like the moratorium, the one-time recast, issues relating to the held to maturity portion of banks' government bond portfolios, which are very critical to this policy. And if the RBI disappoints, I think the markets will be extremely disappointed, because there is need for greater clarity on these fronts, which would actually make a difference to both the credit markets, credit delivery, and ultimately growth. I don't think there is a compelling case for cutting rates at this stage. I don't think inflation is that much of a scare, but given the fact that we have some kind of flexible inflation targeting in place, and we've had some ugly inflation prints, it's good to pause. I think transmission will happen on the back of slowing asset demand, but the RBI could choose to review this. But I think, just to go back to what I said initially, the burning questions are: what happens to the moratorium? What happens to sectors? Can there be micro initiatives in terms of capital that needs to be kept back in order to lend to sectors? Can that be eased? Can there be one-time loan recast for at least some sectors which are most badly affected by COVID? I sincerely hope the RBI gives us some clarity on this. It's about time.
Right. Hi Nilesh, good afternoon. This is Ruchi Bhatia. I would just want to understand from you, the poll seems to suggest that the chances for a reverse repo cut is far higher. But do you think that will be enough to nudge the banks to, not park their funds to the RBI so far? Because so far we've seen almost 7 to 8 lakh crores being parked, with the RBI.
The reverse repo rate cut will definitely put some pressure on the short-term yields. But for banks to start lending, rate cut alone is not the right mechanism. The lending activity at banks have stopped for a variety of reasons. One could be risk aversion, clearly because of current crisis situation. Second could be lack of equity in the balance sheets of borrowers, as raising equity, bearing few exceptions, has been difficult. Third is also the whole process of credit disintermediation, where we have seen lending markets taking a big share compared to capital markets, as entry in capital market is restricted to just AAA rated names, and that also backed by sovereign. So we have to tackle credit delivery problem at variety of level. RBI has pumped up liquidity for some time and far more during this crisis situation. They have also given commitment towards softer monetary policy in the pandemic as well as post-pandemic phase. Now, what we need for credit delivery is deepening of bond market as well as giving administrative flexibility to bankers so that they can take banking lending decision without fear of consequences.
Right. In fact, let me also get Sonal Verma as well on board. Hi, Sonal. You know, we've seen the real interest rates turning negative in the system. Do you think that this is going to continue? And what's your view on real interest rates and inflation dynamics going forward?
Yes. So the current negative real rate regime that we are in should most likely be transitory, because the high headline inflation is partly statistical, partly because of the supply shocks on food. And the expectation is that the more durable demand destruction will bring down core inflation, and inflation from a 6 to 12 month perspective will get back to the RBI's target. So while real rates are negative right now, they should turn positive, or at least going back closer to zero, depending on the measure we use going forward. So really the current negative real rate regime is transitory. But clearly there's been a shift in terms of the average real rates we are seeing. We've moved from a very high positive real rates 3-4 years back to now a fairly low real rates. And that, to my mind, clearly reflects a fairly weak economy that we have, with output gap still negative. We don't need very high real interest rates, because the demand for capital for investment is quite low. So low relative to history, but the current negative real rates is also not a steady state.
Okay, I'm just going to quickly get your status check on what the markets are up to. We're holding our okay. You know, it's really not a Nifty day today. The day really belongs to mid-caps. While the Nifty also, I must admit, is after what looked like a very listless start, has somewhat picked up. We're holding about 63 odd points for the futures right now, 20 odd points shy of that 11,200 level. But today, the traction and action really is in the broader markets. NIT Technology is holding up 4.5%. Look at Tata Consumer. The kind of move that you're seeing on that stock, 5% higher in the futures. REC, Z, Oro Pharma, these are all stocks which are holding out very well. What's the Nifty Bank then up to? Axis Bank under pressure right now. It's down about 1.3%. ICICI Bank as well is looking a little placid, down about 0.4%. IndusInd, SBI, not seeing very big material moves on any of these names. So pretty quiet, you'd have to say. It's a mixed bag of sectors. Media led by Z, Pharma, Technology, Power. These are sectors which are holding out along with FMCG, Automobile, Banks, Cap Goods, Textile, etc. Within the futures and options universe, they are in a bit of a tug-of-war zone, so to speak. But, you know, Abhi, you gave us a very interesting phase. It's the burning question, really. What is the RBI going to choose to do on the moratorium? And, you know, just a short while back, we were playing soundbites of all the top bankers, and they're vehemently opposing any extension of loan moratorium scheme. The deadline for which, of course, is August 31st. Deepak Parekh is pointing out that a blanket moratorium means that even the borrowers who can afford to pay will be taking undue advantage. Uday Korak is saying that, suggests the pill of one-time loan restructuring rather, so that banks can be better prepared for tomorrow. Also, in its latest RBI financial stability report, the RBI themselves have warned against NPAs and how they could balloon in the times to come. What do you think is the right methodology here? And would you go here with what Uday Kotak is suggesting, that a one-time loan restructuring is the best possible pill right now for the problem at hand?
I would tend to agree, and I think there is, considerable distress in certain sectors of the economy, and perhaps given that the RBI can choose to be a little selective about where it allows a recast, but some recast of loans, I think, is possibly the only way forward. Because these are extraordinary times, and a number of sectors have, despite some of the green shoots that have been sort of pointed to earlier by the finance ministry and so on, some sectors are still down in the dumps. And just extending moratorium leads to, you're just kicking the can down the road. You have to do something a little more permanent, which can take care of these sectors for the foreseeable future, because I don't see things turning around in a hurry. So yes, I do believe that loan recast is the best way forward. And perhaps, if the RBI doesn't want to use it across the board, doesn't want to use it as a sort of a blunt instrument where everyone has access to some restructuring, it can be selective about sectors. That has its own problems. Implementation is difficult. There are always going to be questions about why certain sectors were chosen, certain sectors were left out. But I personally think that loan recast with some selectivity is perhaps the way forward.
Nilesh, in March, Shaktikanta Das used that famous phrase, whatever it takes. And since then, we've seen a series of 115 bips of a rate cut already come back in. But we all know that the economy is still struggling, and that's public knowledge now. What exactly can the central bank do to try and infuse and instill growth back into the economy from their end? Nilesh?
Okay. See, a central banker in a crisis situation will have to go with the mindset of winning the match. What shot one has to play will be determined based on what kind of pitches and what kind of bowling you get. You know that asking run rate for India will be about 7 to 8% GDP growth. This year, we will be probably down between -5 to -10. So effectively, which whatever it takes, we will do appropriate mindset. And in terms of steps taken, they have increased liquidity significantly. It's into negative real territory. Now they need to focus upon credit, especially one-time restructuring, which will enable credit to flow to the needy people, will be important. Second, RBI also will have to focus on market where the yield curve has become steeper, and probably the benefit of drop in short-term interest rates are more visible, but the medium to long-term interest rate is high. The credit cost for non-AAA rated borrowers continue to remain elevated. And now RBI should focus on not only credit transmission, but also transmission of interest rates. And then they have to work with the government to ensure that both fiscal and monetary stimulus is on the growth side.
Right. Let me also get Maithili on that point. Maithili, we at ET Now have always been discussing with you whether it is the role of the monetary policy or the fiscal policy to revive growth. At a time like this, when the government has already announced a 20 lakh crore rupee package in which we've seen very little money actually being put in the hands of people, I want to understand from you at this point of time when we're seeing inflation moving past our expectations, growth still stuttering, what would be the right kind of approach, because there's still a lot of uncertainty going forward?
Pet peeve of mine, which is that fiscal policy has not done what it should do. All the heavy lifting has been done by monetary policy and to very little avail. So I think the ball is very squarely in the government's court, has been there for some time. And unless government increases their spending, frankly, there's very little that the MPC or the Reserve Bank of India can do, which is why one is looking for some kind of regulatory forbearance. But remember, it could go too far because post-2008, the rapid increase in loan offtake that we saw, that is what has brought us to the sorry past of very high NPAs. So by pushing banks to lend, we could be setting up the next NPA cycle a few years down the line. So banks need to be cautious because these are times of very, very high uncertainty. And when you lend, the level of risk is much higher. So I believe now, and has been so for a while, has been that it's for the government to step up and start spending more, because as we know very well, the huge package they announced was basically driven by credit and guarantees. That is not the way to go forward in a country like ours, particularly as we're seeing the rising number of cases and the difficulty in getting the economy to open up completely is going to be a while. We are going to hurt, and the answer lies squarely with the government, not with the Reserve Bank of India.
Oh, absolutely right. Just about a minute to go for the RBI Governor Shaktikanta Das to speak. Let me get Abhig Barua on that. Abhig, do you agree with what Maithili has said, that at this point of time, much of the heavy lifting should now be done by the government? A lot we've seen that the kind of steps that the RBI has taken will help the economy, but now the ball is in the court of the central bank, of the government.
Right, it is pretty much in the court of the government. And I think in this kind of a situation where we have an unprecedented shock to the economy, fiscal policy does has a major role to play, and it cannot be substituted for by policies just to drive credit growth and improve credit delivery. So I think, and if you just look at what other economies have done, not just the developed economies, but also some of our emerging market peers, there is an element of a reasonable fiscal push in all of their strategies, and that's something we kind of have skipped on, possibly driven by concerns about fiscal stability and where the debt path will head going forward, and so forth. But in the absence of fiscal policy, monetary policy can do very little, because even if it sort of eases the process of credit delivery, lowers the cost of credit, in the absence of fiscal support, you might see a situation where there is simply no demand for credit, or the demand environment is so vitiated by risk that bankers, and justifiably and legitimately so, just hold back on lending. So, fiscal policy is very, fiscal policy and a fiscal stimulus is very critical at this stage. And there's time yet to, come up with a more focused fiscal policy over the next couple of months, recognizing the fact that the impact of the virus has both prolonged and has become more dispersed.
As you are aware, this is the monetary policy statement. In the initial part, I would be focusing on the aspects of the decision by the Monetary Policy Committee. And in the later part, I have some important announcements to make. And I request your patience. The Monetary Policy Committee met on 4th, 5th and 6th August for its second meeting of 2021, which is the 24th under its aegis, completing 4 years of its operation under the new monetary policy framework. The MPC sifted through domestic and global conditions and evaluated their unfolding impact on the overall outlook for India and the world. At the end of its deliberations, the MPC voted unanimously to leave the policy repo rate unchanged at 4% and continue with the accommodative stance of monetary policy as long as necessary to revive growth, mitigate the impact of COVID-19 while ensuring that inflation remains within the target going forward. The marginal standing facility rate and the bank rate remain unchanged at 4.25%. The reverse repo rate also stands unchanged at 3.35%. I thank the MPC members for their valuable contributions to the policy decision taken today. The Reserve Bank of India is perhaps the only central bank in the world to have set up a special quarantine facility with its officers, staff and service providers numbering about 200 for critical operations to ensure business continuity in banking and financial market operations and payment systems. Other teams in the RBI have ensured availability of digital banking channels, ATMs, internet and mobile banking, cyber security, redress of customer grievances, and carried out sustained campaigns about safe digital transactions through RBI Kehta Hai. Our teams have also provided logistical support and engaged in analysis and research to back the conduct of the financial and monetary policies. I am proud of all of them for their tireless commitment to public service. I would also like to applaud all employees of banks and financial entities for ensuring uninterrupted operations in these trying times. Our gratitude also goes out to all COVID warriors, medical and health personnel, police and other law enforcement agencies, authorities at various levels and others. In the MPC's assessment, global economic activity has remained fragile and in retrenchment in the first half of 2020. A renewed surge in COVID-19 infections in major economies in July has subdued some early signs of revival that had appeared in May and June. Global financial markets, however, have been buoyant, with return of risk-off sentiment inserting a disconnect from the underlying state of the real economy. Portfolio inflows to emerging markets have resumed and their currencies have also appreciated. The Global Manufacturing Purchase Managers Index PMI and Global Services PMI rose to 50.3 and 50.5 respectively in July, moving back to the expansion zone. The World Trade Organization has estimated that the volume of merchandise trade shrank by 3% year-on-year in Q1, and early estimates suggest a fall of 18.5% in Q2. CPI inflation remains largely subdued across major advanced economies, primarily due to benign fuel prices and soft aggregate demand since March. In most of the emerging market economies, however, CPI inflation after easing in April and May rose in June amidst cost push pressures. Domestic food inflation remains elevated across most of the economies since the onset of the pandemic. The MPC noted that in India too, economic activity had started to recover from the lows of April and May. However, surges of fresh infections have forced reclamping of lockdowns in several cities and states. Consequently, several high-frequency indicators have leveled off. The agriculture sector's prospects are strengthened by the progress of the southwest monsoon and the expansion in the total area sown under Kharif crops by 13.9% up to July 31 over the previous year. That is, over the corresponding period of the previous year. Industrial production remained in contraction, albeit at a moderated pace in May. The Manufacturing Purchase Managers Index, PMI, shrank in July for the fourth consecutive month. PMI services remained in contractionary zone in July, although the downturn eased relative to the June reading. Headline inflation, which was 5.8% in March, was placed at 6.1% in the provisional estimates for June 2020. Inflation pressures were evident across all subgroups. Households 1 year ahead inflation expectations were lower than their 3 months ahead expectations in July 2020 round of the Reserve Bank's survey. indicating their anticipation of lower inflation over the longer horizon. Producers' sentiment on input prices remained muted as their salary outgoes fell. The selling price contracted in Q1 in April to June round of the Reserve Bank's Industrial Outlook Survey. India's merchandise exports contracted for the fourth successive month in June 2020, although the pace of fall moderated. Imports fell sharply in June in a broad-based manner, reflecting weak domestic demand and low international crude oil prices. The merchandise trade balance recorded a surplus in June of the order of US $0.8 billion after a gap of over 18 years. India's foreign exchange reserves have increased by 56.8 billion in the current financial year, that is in 2021, so far during April to July, to 534.6 billion US dollars as on July 31st, 2020, equivalent to 13.4 months of imports. The ratio of foreign exchange reserves to external debt has gone up from 76% at the end of March 2019 to 85.5% at the end of March 2020. Let me now focus on the outlook for growth and inflation. Against this backdrop, the MPC was of the view that supply chain disruptions on account of COVID-19 persist, with implications for both food and non-food prices. A more favorable food inflation outlook may emerge as the bumper Rabi crop harvest eases prices of cereals, especially if open market sales and public distribution offtake are expanded on the back of significantly higher procurement. Nonetheless, upside risks to food prices do remain. The abatement of price pressures in key vegetables is delayed and remains contingent upon normalization of supplies. Protein-based food items could also emerge as a pressure point. High domestic taxes on petroleum products have resulted in elevated domestic pump prices and will impart broad-based cost push pressures going forward. Taking into consideration all these factors, the MPC expects headline inflation to remain elevated in Q2 2021, but likely to ease in the second half, aided by favorable base effects. As regards the outlook for growth, the MPC noted that recovery in rural economy is expected to be robust, buoyed by the progress in Kharif sowing. Manufacturing firms expect domestic demand to recover gradually from Q2 and to sustain through Q1 21-22. On the other hand, consumer confidence turned more pessimistic in July relative to the preceding round of Reserve Bank's survey. External demand is expected to remain anemic under the weight of global recession and contraction in global trade. Taking into consideration the above factors, real GDP growth in the first half of the year is estimated to remain in the contraction zone. For the year 2021 as a whole, real GDP growth is also estimated to be negative. An early contraction, or rather an early containment of COVID-19 pandemic may impart an upside to the outlook. A more protracted spread of the pandemic, deviations from the forecast of a normal monsoon, and global financial market volatility are the key downside risks. The MPC noted that in an environment of unprecedented stress, supporting recovery of the economy assumes primacy in the conduct of monetary policy. While the space for further monetary policy action is available, it is important to use it judiciously to maximize the beneficial effects on the underlying economy. At the same time, the MPC is conscious of its medium-term inflation target. The headline inflation prints of April and May 2020 are obscured by the spike in food prices and cost push pressures. Meanwhile, the cumulative reduction of 250 basis points is working its way through the economy, lowering interest rates in money, bond, and credit markets, and narrowing down the spreads. Given the uncertainty surrounding the inflation outlook and extremely weak state of the economy in the midst of an unprecedented shock from the ongoing pandemic, the MPC decided to keep the policy rate on hold while remaining watchful for a durable reduction in inflation to use the available space to support the revival of the economy. There are more details available in the MPC's resolution, which will be uploaded immediately after this statement is over. So I would encourage everyone to have a look at the resolution of the MPC, which contains even greater details. Living with the pandemic has improved the way we manage it. Working from home, virtual meetings, and contactless transactions. Throughout this traumatic period, one thing has stood out: the indomitable spirit of humanity. The inner conviction that whatever be the challenge, we have the innate resilience to combat them, overcome them, and emerge victorious. I continue to be an eternal optimist, and I feel Mahatma Gandhi should inspire us. And in Mahatma Gandhi's words, if our resolve is firm and our conviction clear, it would mean half the battle won, unquote. Let me now highlight, against this backdrop, I would like to highlight the impact of the monetary and liquidity measures so far taken by the Reserve Bank to mitigate the negative fallout of COVID-19. I thought it necessary to point out some of these aspects which are known, which are obviously available in the public domain. But I often hear questions being raised in the public space about the effectiveness of the rate cuts that the MPC has undertaken over the past, starting from February 19 and more in a more pronounced manner after the onset of the pandemic. So I thought it is necessary that let me in brief highlight some of the impact in our assessment, the impact of the monetary and liquidity policy measures which have been undertaken by the Reserve Bank. It may be noted that transmission of the rate cuts by MPC would not have been possible to the extent achieved so far without creating comfortable liquidity conditions. The overriding objective was to prevent financial markets from freezing up, ensure normal functioning of financial intermediaries, ease the stress faced by households and businesses, and keep the lifeblood of finance flowing. This is achieved by infusing large amounts of liquidity in and out of the system through injections and absorptions through the LAF. In the process, the easing of financial conditions has actually enhanced monetary transmission and thereby the effectiveness of MPC's accommodative stance and actions. What is more, the injections of liquidity, including through open market operations, special operations for what we call the open market operations, then special operations by way of what we call Operation Twist, the LTROs, the TLTROs, and the forex interventions. There being that, and this is very important to note, all this liquidity which are being injected into the market and which is there in the system, they are being fully sterilized by absorptions through the reverse repo, while preventing a seizure of money markets under extreme risk aversion and uncertainty. And this is a very important point, which I think I feel and all of us in RBI feel needs to be appreciated. Another aspect that needs to be recognized is that RBI's open market purchases are aimed at reducing funding costs for private sector entities that issue instruments in the market which are usually priced off the GSEC yield as the benchmark. In fact, it is worthwhile to see who is benefiting from the RBI's actions. Borrowing costs in financial markets have dropped to their lowest in a decade on the back of abundant liquidity. Interest rates on instruments like the 3-month Treasury bill, commercial paper, and certificates of deposit have fully priced in the reduction in the policy rate and are in fact trading below the policy rate in the secondary market. Commercial papers of NBFCs have softened to 3.8% on July 31st. Rates have fallen to 3.4% on July 31st, 2020 for non-NBFC borrowers. So as you can see, the cost of borrowing for NBFC borrowers and non-NBFC borrowers have significantly come down. And the NBFC sector, which was in stress post-ILFS throughout, in the early part of 2019, have now access to funding at reasonable costs. With illiquidity premia dissipating under the impact of Operation Twist and TLTRO1 spreads of 3-year AAA rated corporate bonds over similar tenor securities have also declined from 76 basis points on March 26th to 50 basis points. So on March 26th, that is on March 27th, if you remember, we announced our first set of measures to deal with the onset of the pandemic, to deal with the COVID crisis. And that was on March 27th. So March 26th, the spread on AAA rated corporate bonds, and I'm referring to the 3-year AAA rated corporate bonds, it was 276 basis points over the GSEC of similar maturity. And that spread over GSEC of similar maturity has come down from 276 basis points from March 26th to 50 basis points on July 31st, a significant reduction indeed. And in fact, in all other categories, AA, whether it is AA plus or AA bonds, they have also considerably narrowed. Even the lowest investment grade bonds, that is BBB minus, spreads have also come down by 125 basis points as on July 31st. Lower borrowing costs have led to record primary issuance of corporate bonds of the order of rupees 2.09 lakh crore in the first quarter, that is April to June 2020-21. In particular, market financing conditions for NBFCs, which had become challenging, have largely stabilized in the wake of targeted policy measures undertaken by the Reserve Bank. Abundant liquidity has also supported other segments of financial markets. In particular, mutual funds have stabilized since the Franklin Templeton episode. Assets under the management of debt mutual funds have also recovered and significantly improved to 13.89 lakh crore as on July 31st, 2020. Monetary transmission has also improved considerably. The weighted average lending rate on fresh rupee loans sanctioned by banks declined by 162 basis points during the period February 2019 to June 2020. I'm referring to February 2019 because that is when the accommodative stance of Reserve Bank's policy, monetary policy, and the liquidity injections, the whole cycle, and the accommodative stance and the rate cut cycle, it began in 2019. So between February 2019 to June 2020, the weighted average lending rate on fresh rupee loans sanctioned by banks, they have come down by 162 basis points. Now, of which 91 basis points transmission was witnessed during the month of March 2020 to June 2020. That is from March to June in the post-pandemic period. Now, let me now turn to announcing some additional measures. With COVID-19 infections rising unabated under fragile macroeconomic and financial conditions, we propose to undertake additional developmental and regulatory measures with several objectives, and they are as follows. Number one, to enhance liquidity support for financial markets and other stakeholders. Number two, to further ease financial stress caused by COVID-19 disruptions while strengthening credit discipline. Number three, to improve the flow of credit. Number four, to deepen digital payment systems. Number five, augment customer safety in check payments. And number six, facilitate innovations across the financial sector by leveraging on technology. These are the objectives behind the policy measures which we are going to announce, which I am going to announce today on behalf of the Reserve Bank. In the worst peacetime health and economic crisis of the last 100 years that we face today, the regulatory response has to be dynamic, proactive, and balanced. While designing the major announcements that I am making today, we have ensured that necessary safeguards are in place for preserving financial stability. We are fully mindful of RBI's responsibility to maintain stability of the financial sector. While I am outlining the main measures, the statement on developmental and regulatory measures will address them in greater detail. And this statement, as I mentioned earlier, will be uploaded after this statement is over. Among the various measures that I am going to announce, the first one relates to additional special liquidity facility. Additional special liquidity facility of rupees 10,000 crore will be provided at the policy repo rate to the NABARD and to the National Housing Bank. And this will consist of 5,000 crore to National Housing Bank, NHB, to shield the housing sector from liquidity disruptions and augment the flow of finance to the sector through housing finance companies. And it will also consist of 5,000 crore to the National Bank for Agriculture and Rural Development, that is NABARD, to ameliorate the stress being faced by smaller non-bank finance companies, NBFCs and macrofinance institutions in obtaining access to liquidity. The next announcement relates to resolution framework for COVID-19 related stress. The Prudential Framework on Resolution of Stressed Assets, dated June 7, 2019, provides a principle-based resolution framework for addressing borrower defaults. Any resolution plan implemented under the Prudential Framework which involves granting of any concession on account of financial difficulty of the borrower entails an asset classification downgrade, except when accompanied by a change in ownership subject to certain specified conditions. The disruptions caused by COVID-19 have led to heightened financial stress for borrowers across the board. A large number of firms that otherwise maintain a good track record under existing promoters face the challenge of their debt burden becoming disproportionate relative to their cash flow generation abilities. This can potentially impact their long-term viability and pose significant financial stability risks if it becomes widespread. Accordingly, it has been decided to provide a window under the June 7 Prudential Framework of the Reserve Bank, that is June 7 of 2019. Under that framework, it has been decided to provide a window to enable lenders to implement a resolution plan in respect of eligible corporate exposures without change in ownership, as well as in respect of personal loans, while classifying such exposures as standard assets subject to specified conditions. In the light of past experience with regard to use of regulatory forbearance, necessary safeguards have been incorporated, including prudent entry norms, clearly defined boundary conditions, specific binding covenants, independent validation, and strict post-implementation performance monitoring. The underlying theme of this resolution window is preservation of the soundness of the Indian banking sector. The Reserve Bank is also constituting an expert committee with the chairmanship of Shri K.V. Kamath, which will make recommendations to the RBI on the required financial parameters, along with sector-specific benchmark ranges for such parameters to be factored into resolution plans. The expert committee shall also undertake a process validation of resolution plans for the borrower accounts above a specified threshold. The details of the resolution framework as spelled out in Part B of the MPC resolution and in the relevant circular, both of which will be issued immediately after this press statement. The next announcement, that is the third one, relates to restructuring of MSME debt. A restructuring framework for MSMEs that were in default but standard as on January 1st, 2020 is already in place. The scheme has provided relief to a large number of MSMEs. With COVID-19 continuing to disrupt normal functioning and cash flows, the stress in the MSME sector has got accentuated, warranting further support. Accordingly, it has been decided that stressed MSME borrowers will be made eligible for restructuring their debt under the existing framework, provided their accounts with the concerned lender were classified as standard as on March 1st, 2020. This restructuring will have to be implemented by 31st March 2021. The fourth announcement relates to advances against gold ornaments and jewelry. As per extant guidelines, loans sanctioned by banks against pledge of gold ornaments and jewelry for non-agricultural purposes should not exceed 75% of the value of gold ornaments and jewelry. With a view to mitigating the impact of COVID-19 on households, it has been decided to increase the permissible loan to value, what they call LTV ratio, for such loans to 90%. This relaxation shall be available till 31st March 2021. The fifth announcement relates to banks' investment in debt mutual funds and debt exchange traded funds, capital charge for market risk. As per RBI's extant Basel III guidelines, if a bank holds a debt instrument directly, it would have to allocate lower capital as compared to holding the same debt instrument through a mutual fund or exchange traded fund. It has been decided to harmonize the differential treatment existing currently. This will result in substantial capital saving for the banks, and it is also expected to give a boost to the corporate bond market. Number 6. We have a review of priority sector lending guidelines. With a view to aligning the guidelines with emerging national priorities and bring sharper focus on inclusive development, the priority sector lending guidelines have also been reviewed. An incentive framework is now being put in place for banks to address the regional disparities in the flow of priority sector credit. Now, this has been visible for quite some time. Most of priority sector lending gets concentrated in certain areas, and whereas there are several other states where the priority sector lending is not what it should be. So therefore, what we have decided is that while higher weightage will be assigned for incremental priority sector credit in the identified districts having lower credit flow, a lower weightage would be assigned in identified districts where the credit flow is comparatively higher. Priority sector lending status is also being given to startups, and the limits for renewable energy, including solar power and compressed biogas plants, are also being increased. There are other measures that are being announced today, and I shall be very brief. Number 1, introduction of an automated mechanism in e-Kuber system to provide banks more flexibility and discretion in managing their liquidity and maintenance of cash reserve requirements. Number 2, while permitting lenders to provide relief to the borrowers through various measures, it is also considered necessary to take appropriate measures for strengthening credit discipline. In view of the concerns emanating from use of multiple operating accounts by borrowers, both current accounts as well as cash credit or overdraft accounts, it has been decided to put in place certain safeguards for opening of such accounts for borrowers availing credit facilities from multiple banks. Number 3, the Reserve Bank has constantly endeavored to encourage responsible innovation by entities in the financial service sector. In order to further promote and facilitate an environment that can accelerate innovation across the financial sector, the Reserve Bank will set up an innovation hub in India. Further details about the innovation hub would be announced in due course. To enhance safety of check payments, it has been decided to introduce a mechanism of positive pay for all checks of value rupees 50,000 and above. Operational guidelines in this regard will be issued separately. And finally, a scheme of retail payments in offline mode using cards and mobile devices and a system of online dispute resolution mechanism for digital payments will also be introduced. In conclusion, let me say as follows. At this juncture, the war against COVID-19 is most intense, and the world is bracing up for a second wave as it cautiously opens up. The pandemic poses a challenge of epic proportions, but our collective efforts, intrepid choices, innovations, and true grit will eventually take us to victory. As Mahatma Gandhi had said, patience and perseverance, if we have them, overcome mountains of difficulties, unquote. The challenges of today will only strengthen our resilience and self-belief. We shall remain alert and watchful and collectively do whatever is necessary to revive the economy and preserve financial stability. Courage and conviction will conquer COVID-19. Thank you very much.
Courage and conviction, patience and perseverance. We've had an accommodative stance, pause in rates, unchanged, and a one-time restructuring without asset classification downgrade coming in for all sectors. Maithili, let's get your first take. Markets are actually rejoicing. We're at the high point of the day. we're back to 11,200. Maithili, can you hear me? Just wanted your first take. While it's played along expected lines, what to your mind stood out from the governor's speech today?
Yes, very much along expected lines. Status quo on rates was expected. Accommodative stance was also expected. Of course, there was a little bit of hope that the RBI might become a little clearer in terms of the GDP numbers, but I think it's wise in these circumstances not to come out specifically with a number. I think the biggest takeaway really is the change in the resolution framework. The June 2019 circular was very restrictive. So banks have now been given a great deal of flexibility, one hopes, but one doesn't know what are the stringent conditions that the RBI has imposed on the banks, but we'll have to go through the fine print. But as of now, I think it's a good beginning.
Have a sip of water. I'm going to quickly go through some of the other takeaways in the meantime. 11,200 right now for the index. You've seen actually a big move up on banks, and I'm going to quickly bring up some of the intraday graphs for you. In SBI, for instance, was pretty flattish going into policy. It's picked up about 0.6%. I can see ICICI Bank as well trying to make an effort at least to hold up. Similar is the move within HDFC. Reliance as well has picked up some steam, and HDFC Bank now at the high point of the day, 1.25% higher. Abhik, along expected lines, anything that particularly stood out to you from the governor's speech today?
So, but I thought that the emphasis on inflation was important because it still is important to kind of stick to our model of flexible inflation targeting and recognize that we might have temporary inflation pressures, and consider the inflation risks even in a scenario where growth is crumbling, because the nature of the inflation animal today is very different. The COVID pandemic has come as both a demand and supply shock, so we would have pressures both from particularly from the supply side for inflation to remain elevated. So I think by recognizing it, it just sort of confirms the fact that we do have the extant model in place, although we've decided to become a little more accommodative in terms of monetary policy. And of course, the fact that they are ready to cut as the situation warrants. I think given the fact that, as the governor mentioned, the pandemic is far from over, and we might have a second wave or more dispersion of the virus within across the country. I think we need to keep our powder dry and use, as the governor again said, use it judiciously when it is more effective. So I thought that was a very sort of succinct summary of the kind of strategy going forward that the RBI will follow in sort of setting rates. Given that it does have, although it has some policy, some space to cut policy rates, it is somewhat limited, having done so much. I would look to the details of the resolution plan, how much of a difference, clearly the markets seem to have taken this positively. I think the markets have also taken the absence of a change in the reverse repo rate positively, because it just means that banks' returns by putting their money and not taking risk is kind of still protected at the old level. But I think the resolution plan and the fine print of that is critical. What does it do to banks? How much leeway does it have? And I think we just have to sort of go through the minutiae of that to figure out how exactly banks will be impacted. But I reckon that is a major step forward.
Abhik. Right, Abhik. Just hold that thought. Let me also get on board Ashima Goyal. She's also joining us on the phone line. Hi, Ashima. Good afternoon. This is Ruchi Bhatia. Your first take on the policy announcement that we just heard the RBI Governor making. It's a pause as far as rates are concerned. A crucial commentary coming in on the expectations that inflation will continue to be at elevated levels. GDP is going to be in negative territory, and a one-time restructuring scheme also coming in. How are you looking at all the announcements that have been made today?
I think it's really it's excellent, because I expected a pause because of the continued spikes in inflation and the uncertainties about the supply side lockdowns. But I also thought that they should look through the spike in the sense, say that there is space and that they expect inflation to come down. I think inflation expectations really are influenced by what the RBI says. And this fact that the governor pointed out is very, very relevant when he's saying household inflation expectations are lower 3 months ahead rather than 1 month. So even households know that this current spike is due to temporary supply chain disruptions and is likely to get worked out as unlock proceeds and as the effects of the good monsoon, etc., are felt. Yeah. So pause, but communicate that inflation is going to come down in the future, and there is therefore space for further cuts in the future. At present, there's a lot of uncertainty. See what happens to growth, how the COVID virus itself is tackled. I think states should take the lesson that arbitrary lockdowns and full lockdowns are not needed. Targeted containment strategies work much better. Then supply chains can recover. Yeah, and then also I liked some counter-cyclical prudential measures which will reduce the cost of borrowing further. The recognition that liquidity and surplus has really helped pass through. I would have welcomed a slight reduction in the reverse repo rate in order to make it more profitable to push banks more towards lending rather than parking money in reverse repo. But this parking money in reverse repo is essential to, when you are giving liquidity, then you must also withdraw it if it's not being used productively. Yeah.
Ashima, just want to understand from you the fact that the RBI governor did say that GDP is going to continue to be in the negative territory. In terms of policy action, we've seen the RBI doing quite a lot now in terms of a one-time restructuring as well. Of course, it's now on to the government as well, right, in terms of what kind of further steps can be taken in the months to come to push growth from the current levels.
Yes, absolutely. I think at the current juncture, you need a fiscal push, because interest rates, when people are saving precautionary rather than consuming, and firms are waiting for consumers to begin spending. So you need demand push from the government. And there I think this policy, like they've marked.
Okay, but I think we've snapped that line with Ashima Goyal. I'm just going to get back to her in just a second. But, two takeaways, Maithili. That the RBI has permitted one-time restructuring without asset classification downgrade. And B, the loan-to-value ratio for gold loans has now been raised to 90%. The only clarity that I don't have so far is whether this is for banks or is it for gold NBFCs as well. Because if that's the case, then this is big market news as well. And we should, bring up some of those gold financiers because they definitely would be reacting to this news. Your reading of these two announcements, Maithili?
Let me take the second one first, Asha. I think it would be for both. And this is clearly driven by the run-up that we've seen in gold prices, which is why we've seen that the RBI has allowed it only temporarily till March 2021, because one doesn't know really where the gold prices would be in March 2021. So it is a temporary measure, and yes, it will really help, particularly small borrowers, households in rural areas who are heavily dependent on gold loans. And it will help companies like Manappuram Finance, etc., all the smaller, no, I wouldn't call them small really, the NBFCs which are, focus mostly on gold loans, particularly in the south of the country. So yes, I would expect it to apply to both. And this is, as I said, rightly said, a temporary relaxation given the run-up that we've seen in gold prices. As far as your first question is concerned, the one-time restructuring is good, Aisha, but he very carefully did not enunciate what are all the conditions that the RBI would expect banks to follow. And if I know RBI, I was listening to the former Deputy Governor, N.S. Vishwanathan, and he said yes, very reluctantly, because he was fairly strict about not allowing restructuring earlier. And recently he has come around to say, yes, he would be okay with restructuring, but it's very tightly controlled. Now, the problem when you say tightly controlled is that the RBI steps into what is basically the bank's domain. Now, this should be a commercial decision. Once you allow them to do restructuring, you should leave it to their good commercial judgment to decide what is passé and what is, kosher and what is not kosher. But the moment you tie it up in too many strict years, it becomes very difficult. So I do hope the RBI has not done that. We have to see the fine print that the governor did not elaborate. He said we'll be putting it up on the website. So we'll have to go through whatever they put up on the website to see that the RBI has not tied them so completely in knots as to make this one-time restructuring, irrelevant completely. We have to see, particularly because they've again said that you have an expert committee under Mr. K.V. Kamath. So to me, my mind, it sounds very much like the RBI, micro-regulation, getting into the business of the banks. So I hope that I'm proved wrong and the RBI does give banks a little bit more elbow room and flexibility, because that is what we need to do, give them the flexibility and then hold them accountable, not for decisions that go wrong, but if there's any malified intent, which is proven. Today, the problem that has arisen is because we assume that every bad law is because of malified intent. And that is why no banker is willing to lend. So what one must accept is that banking is the business of taking risks. As long as these risks are taken based on bona fide decisions with due diligence and in good faith, you must not penalize a banker. So I do hope the RBI has borne that in mind and taken the lessons of 2008 and carried them too far and drawn the wrong lessons. Sorry, Aisha, for a long answer, but this is something I've been very passionately about, having started my career as a commercial banker in State Bank of India.
No, absolutely. And I wanted that detailed take from you. By the way, since there is that clarity that Maithili just talked about, that it's for gold NBFCs as well. Just look at the move on a Manappuram, on a Muthoot, or for that matter, even a federal bank. We all know that these stocks have been the darling for equity markets for a while now, ever since the uptick in gold prices actually came to play and was... we all know as to how gold prices have actually been holding up, what with the move at a 9-year high on gold and now, the other metals as well catching up. But just look at the intraday spike that you're seeing on most of these names. The last time I checked, we were holding about almost 4.5% at the high point of the day for a Muthoot. Similar movement coming in for a Manappuram, and my sense is that Federal Bank as well should be following suit. But Nilesh, from a market messaging point of view, how is it that you're reading into the policy outcome?
So one, as a mutual fund industry, we are very happy that RBI has harmonized capital adequacy norms for direct investments in debt instruments, as well as investments via debt mutual funds, including exchange-traded fund. Such kind of level playing field is extremely important if we want to develop overall markets, and we are very happy that RBI has done it. The second thing from the banking and financial services sector point of view is limited opening of restructuring window. Clearly, there has been opinion mounted on the reduction in credit culture, degradation in credit culture due to moratorium. It might be appropriate to have a one-time restructuring window for needy borrowers so that the credit culture is not degraded further. Both steps are fairly positive, and hopefully they will go a long way in reviving the growth.
I just want to understand from you the fact that now startups will also be given priority sector lending. How important is it for the RBI to go ahead and do something like this, and the kind of impact that you see that it is going to have on startups, the gig economy as well?
The startup economy is driven by venture capital and private equity. Many of them have cash burn model in the initial stages. So giving credit to startup will be a bit of a new challenge for existing banking system. However, there are many startups which have adequate capitalization, which have very good promoters, and they can take leverage in order to improve their return on equity. Many a times these startups are leveraged via offshore investments. It might be appropriate to give a selective opening in local market where they can take leverage in local market as well. It's quite interesting to know that on a fully hedged basis today, local interest rates are cheaper than offshore borrowing. And hence, there will be appetite among startup economy to borrow in local market. This is something which is more of an experiment. But if it works out well, we will ensure that startup economy gets necessary funding, both debt and equity, from the local markets.
This is Maithili speaking from Noida studio. I just wanted to ask you that, as far as the liquidity concerns, RBI's liquidity operations are concerned, isn't there a cost to the sterilization? Because the governor said that whatever liquidity we are pumping in, we are actually sterilizing it. So there's not really fear of the dangers of abundant liquidity. But there is a cost to every sterilization operation. So has the RBI gone a little overboard in terms of infusing liquidity? Ashima?
Yes, hear me?
Yes, Ashima, we can hear you. Please carry on.
Yeah. Maithili, yes, you have to provide. I think what he meant by sterilization was the reverse repo, right? The absorption at the reverse repo. So that is a feature of a modern LAS system, that if you produce excess durable liquidity, more than banks are able to use, since you are injecting this into the system, you have to give banks the option of being able to put it back. And if you give a positive rate on it, then there's an incentive for them to put it back. So you don't get excess liquidity in the system, which can create a lot of problems. As it is, we're seeing asset prices really rising, partly because of the international flows coming in, because of international excess liquidity creation. But of course, there are always some arbitrage opportunities, because liquidity is not provided to, these liquidity windows are not available to all participants in the financial system. So banks are able to, sort of borrow lower from others and park it at the reverse repo. And in my own view, this reverse repo rate could have been lowered a little. That would have increased incentives, because banks are paying more for deposits than they get at the reverse repo. And so there is an incentive for them to lend, but that risk aversion, they are hesitant to start lending. We should see that fading now with the government warranties also. We should see some credit growth picking up. Then that means that this liquidity is being used to create, to increase nominal income, to increase output growth, and being absorbed in the transaction demand for money.
Regulatory forbearance are concerned, am I happy with the one-time restructuring that the banks, RBI seems to have allowed? Though we haven't seen, of course, the fine print, so we don't know how difficult it is going to be for banks. But do you think that is enough? Or could the RBI have gone a little further and given some more leeway also in terms of valuation or the GSEC holdings of the banks, given that all banks are now holding excess SLR? Maybe it could have given them a higher percentage of the HTM, the held to maturity, on which they need not mark to market.
Right. There is some counter-cyclical macroprudential measures which will reduce costs for banks. That is good. It's required at this stage. Maybe more could have been done, but on the whole, I like the cautious approach, in the sense that last time the CDR led to a lot of pushing the can down the road, etc. But at the same time, you don't want a blanket restructuring, because there are people who can repay. Only some firms are really adversely affected. So to let the banks decide, and I think banks as a whole have moved more to risk-based lending. So they're keeping close tracks of their special mention accounts, etc. And only those that are already that are viable or have a chance of becoming viable in the long term should be given this restructuring so that it's productive and a good use of resources for the economy as a whole.
All right, Ashima, many thanks for that. Let me also take it across to Mr. Shetty from SBI, who's also joining in. Mr. Shetty, the RBI, after a lot of deliberations with the bankers, have gone ahead with a one-time restructuring scheme. However, the modalities of the scheme are going to be worked out by a panel that will be led by KV Kamath. They will be suggesting to the RBI what kind of changes are really needed. I want to understand from you, how important do you think is a step like this going to be at a time like this when so many sectors are under a lot of stress? All right, I'm afraid we don't have him on a very good line. We'll try to reconnect, but let me take it across to Abhik. Abhik, this was a common request by all the bankers. In fact, IBA had also asked the RBI to look at a one-time restructuring scheme at a time like this, because earlier we had seen that the ghost of the NPAs were back to haunt the RBI, and now they have a committee that will be put in place. They will be telling the RBI what kind of rules and regulations should be put in. I want to understand from you, what do you think is the need of the hour? What can be done so that we don't make the same kind of mistakes that we've made in the past?
No, I think certainly a one-time resolution or restructuring mechanism was necessary. And I'm happy that they announced something. We have to look at the minutiae of what exactly can be done under this, and how much the committee that the governor mentioned, headed by Mr. Kamath, will play a role in setting parameters and so forth. I have a different take on this than Maithili. I would, what we moved from was a situation, if you like, of extreme discretion towards the end of the last decade, which led to this NPL problem, to a situation of extreme stringency and rule-driven classification of bad loans and so forth. So I think we'll have to walk the middle ground. And I think our experience of leaving things to banks altogether and letting them use their judgment on loan classification, etc., hasn't had a particularly good history. So I would think that in order to relax the stringency, as it were, of the current loan classification system and allow resolution, I think we do need fairly strict parameters under which banks need to operate, so that we don't have another blowout like we saw over the last 8 or 10 years. So I think, yes, some degree of discretion is necessary. Restructuring is necessary, given the fact that there's been so much, damage to companies' P&Ls because of this crisis, and this damage is going to continue, given the fact that we don't have the crisis under control. But we have to walk a very fine line between allowing banks to do their own due diligence and some externally enforced guidelines that the regulator provides. And I would sort of bat for reasonably stringent regulatory guidelines to keep this from becoming another, a big problem like the one we've sort of grappled with over the last few years.
You want to tread a very fine line, but let me now just move to Nilesh. Nilesh, this is Maithili, and I wanted to ask you a question, but I heard you welcome the uniformity of capital charge and banks, holdings in debt directly and what they do through mutual funds. Now, one thing that has puzzled me is that why should banks need to hold any debt instrument through a mutual fund when you can do it directly? After all, they are basically rivals. So where is the need for a bank to invest in a debt mutual fund, Nilesh?
Well, you'll have to give me benefit of doubt as a mutual fund spokesperson. Apart from providing benefit of diversification and liquidity, clearly we can give a benchmark to bank treasury. Banks have multiple functions. They have variety of buckets to fill from an ALM point of view. When they invest in instrument directly, will their duration call, will their credit call always be comparable to market benchmark? Somewhere by investing small portion of their treasury into mutual fund, they can create internal competition where that treasury will try to outperform mutual funds. More importantly, mutual funds also provide liquidity to them, and they can create their ALM sequencing via some investments in mutual fund. Undoubtedly, we play in the same market, but I don't think so mutual funds and banks are competitors. They are partners which have the same objective of generating optimum return from the market.
We have Mr. Sethi as well joining in from SBI. And before I go to him, I just want to quickly bring up the Bank Nifty as well, because, you know, the Bank Nifty is, by the way, at the day's highs right now. In any case, the markets had picked up steam as soon as the policy announcements came in, and we were holding roughly around 1%. But the restructuring for MSMEs, and I think that's gone down very well with some of these banking names. Just bring up the Bank Nifty for you and show you how it's currently panning out. And you can see that spike up. It's currently standing at the day's highs, and clearly the strength in banks rubbing off on the equity markets as well. There you go. Most of these banks are now sitting at the highs of the day. But Mr. Sethi, afternoon. What's been your key takeaway from the monetary policy today?
Yeah, good afternoon. I think it's overall, I think, is a very good policy, both from the intent point of view as well as directionally. While the accommodative stance is continued, obviously the policy rates are remaining untouched. The corridor is left untouched in the sense that between the repo and reverse repo. A few things, I think, in terms of obviously, you know, the restructuring debate which has been going on for so many months probably would come to a some conclusion now. The indication from the governor that detailed guidelines will be issued in terms of the modification to the 7th June circular, I think is a very welcome step in terms of the clarity from the regulatory perspective, whether such framework is going to be there or not. I think that has come to a conclusion.
Yeah, and I had a question for you, because though the governor has spoken in terms of the fine print of the one-time restructuring that will be out in the circular that is put out, they also said that there will be an expert committee under Msme government to look into the modalities. Now, restructuring, etc., has to be done real time. In fact, this is where I think public sector banks, pardon my saying so, have an advantage over public sector banks because they're much more nimble. Now, do you think this is something that we need to have a committee to go into? Do we need to have too many conditions? Or should we give banks a little bit more play, a little bit more flexibility, elbow room? Because it's a decision to extend a loan or give a further loan, if it is taken 6 months down the line, it might be completely useless. So nimbleness, agility is what is needed, in which case we need much more flexibility, not have committees look into the matter. Mr. Shetty?
No, I think even in earlier scheme of things also, if you see, there used to be internal evaluation committees which were there. Only in the 7th June circular, we didn't have an external committee. It was more of a ICA-determined kind of approach. What I understand from the statement, what is coming out now, while the guidelines have to be looked at, is the boundary conditions and the covenants. I think many speakers earlier to me also were expressing apprehension that, whether we go in the same CDR direction, kicking the can down the road. Obviously, none of us, both in the financial sector and the regulators, would like to have a repetition of the same thing. In terms of setting up these boundary conditions and the financial covenants, post-monitoring, post-restructuring monitoring, I think they are very much required. I don't know what kind of conditions are going to come out. I'm sure that they will be practical for implementation. And if you really see in terms of exposures, if you're talking about corporate exposures, the public-private debate it doesn't work because they're all together in the sense that in any corporate exposure, you have all types of lenders and players on board. So unless the regulatory framework is in place, it is very difficult to achieve any resolution. That is one thing which we must be mindful that while it is good to leave the framework flexible for the lenders to adopt the framework, unless you have a clearly defined regulatory framework, it is very difficult to achieve the objective because of the various lender groups which are present in the Indian system and each corporate. So I think to that extent, basically this regulatory framework would be helpful. See, today if you see 7th June circular, what is mainly I think going to be different is that the regulatory forbearance was available only when the change of ownership was there. Obviously, that is going to be difficult in the current circumstances, and that is what is going to be revisited primarily with certain covenants and conditions thrown in.
Right. Mr. Shetty, hi, good afternoon. This is Ruchi Bhatia. I want to understand from you, while this one-time restructuring scheme has come in for, big corporates, mostly sectors that were stressed, they will be cheering a move like this. But what happens to individual loans or retail loans that were taken and for which the RBI had given a moratorium? What happens to that?
See, if you see, one is, of course, so far the book for many lenders has played out well, in the sense that the number of people who have opted for moratorium has significantly come down from phase 1 to phase 2. But if you ask me whether that's going to be sustained, we'll have to see how long this situation is going to be there. But restructuring, if I understand from the statement of the governor, some leeway will be available for the individual borrowers also. So we'll have to see what kind of restructuring framework is going to come for the personal segment. So far, many of the retail book of the lenders have played out reasonably well in terms of the number of people who are availing the moratorium. So post-August, there could be some stress in the retail loans if the cash flows of the companies don't improve or further deteriorate and there are salary cuts, then only we will be able to see the real impact. But there is some mention about the restructuring framework being available to the individuals also. Probably that would be taken care of. And one more thing, I think restructuring of MSME debt, which was available up to 31st December, is now made available up to 31st March 21. And combined with whatever guarantee credit facility the government has provided, I think hopefully will help the MSME sector also.
In fact, I just wanted to ask you about the MSME sector. You kind of preempted my question. The fact that, the government has given a 3 lakh crore rupee credit guarantee facility as well, which has now been extended to individuals who have taken loans from the purpose of supporting their businesses as well. The scope of the scheme has been widened. I want to understand from you the current dispensation that the RBI has allowed. How useful do you think that is going to be? And clearly, the steps that the government has taken add to that the RBI's dispensation. How effective do you think it is going to be to ease the stress in the MSME sector and also support MSMEs during this point of time when we want them to really, get better in terms of their scale and size?
Yeah. See, if you see on the guaranteed emergency credit line, the 3 lakh crore which is allotted for this, in the earlier phase 1, where up to 25 crore limits were covered, almost 1.3 to 1.4 lakh crore sanctions amount already sanctioned. The disbursements obviously will take time because we expect that the disbursements will improve once this festival season begins, and many of the MSMEs have taken the sanction but have not drawn the facility so far. And the second phase, which is covering the 25 to 50 crore limit and up to 250 crore turnover, has brought a lot of SMEs and MSMEs into the fold, because this is if you recall, the 250 crore turnover is also the new definition of MSMEs. there has been demand that they also should be extended this guarantee limit. We assume that another 70 to 80,000 crores will be deployed to these increased criterion, MSMEs, and the professionals, transport operators who were not earlier covered are also brought under that. I think it is definitely going to be providing significant relief to them. Even today, as I'm speaking, three-pronged approach what the government has done in terms of those assets which are standard are provided this guarantee limit. Those which are NPAs, the subordinated debt scheme is also rolled out. I think in next 1 or 2 months you will see the significant support to those accounts which have become NPA, and also the restructuring window which is extended for MSMEs. I'm sure those MSMEs which have credit linkages will definitely be taken care of to a large extent. The issue is there could be some MSMEs who have not had the credit linkage. They have not borrowed any funds. How do we cover them? Is something which we are working out, that particularly in microcredit, we need to support both the NBFCs and MFIs to go to the new microcredit borrowers to support them by way of providing the liquidity now.
Okay, we have Mr. R. Gandhi as well, former RBI Deputy Governor, joining in the show right now. Mr. Gandhi, afternoon. Thanks so much for taking the time out and joining in. The fact that the Reserve Bank has now permitted the one-time restructuring of corporate loans, an important move and much the need of the hour. Would you concur?
Yeah, that is certainly on the expected lines, and Reserve Bank's this announcement has been in a much responsible way as well. Now, there had been chorus of demand for extending the moratorium. I was not actually gunning for it, in the sense that that would have resulted in disturbing the credit discipline and also affecting the profitability and the financials of the bank. So that way, that was not the right solution. Restructuring is certainly the right solution, and that also it has been now left to the decision of the lenders. They can take a call based on the assessment of each borrower and provide for whatever restructuring that is called for. So that way, it is the right method. I am fully endorsing this particular method.
Mr. Gandhi, in addition to that, the loan-to-value ratio for gold loans has now been raised to 90%. And you would think that this is a very smart and prudent move, given how dear the gold prices have already, become, and the kind of, rush for gold loans that we are already witnessing and perhaps are going to continue to do so. So this definitely eases off pressure in the system.
Yes, certainly it is, in my opinion, it is the right approach, because in the current circumstances, if you would look at the data in the past 3 months, all type of loan outstanding had come down. That people had a kind of hesitation about using credit. That is number one, even though by a general assessment across analysts, economists, policymakers, everybody subscribe to the view that cash flow and liquidity is a requirement for the people, and especially for individuals who would, in what way there has been assurance of availability of money whenever they need. And the gold loan becomes the very, very easy and quick method of meeting one's own liquidity requirements. So that given the current price of gold, there is the extra headroom available for giving additional funds to the needy people. So that way, yes, it is. And by the risk, possibly what we have to worry about in the normal circumstances, regulator would have worried about is, in case that there is a default in these gold loans, how the financial system, the banks and others who are extending this gold loan will be protected. So that is where the enforcement by the routine which all these gold loan banks and companies have followed, that should come in good stead for them to see that they are not overly exposed to the risk in this sector.
Mr. Gandhi, hi, good afternoon. This is Ruchi Bhatia. I want to understand from you the fact that MSMEs, now their restructuring will be allowed beyond the 31st of December up until March 31st, 2021 as well. Apart from that, a one-time credit guarantee, the collateral-free loans that the government has also extended. How important will steps like this be to support the MSMEs, especially at a time when there's so much push for a more Atmanirbhar Bharat? We really want our MSMEs to also have a bigger scale and size as well.
See, there are two important requirements will be there for MSME in the coming days. One is to take care of their liquidity situation, and the other is the demand situation. And of course, supply chain also need to be ensured. These are the three primary requirements which MS for the revival of MSMEs across the country. So there, liquidity, availability of liquidity, that is that the monetary policy can ensure, and my regulator has already announced various types of liquidity support for this segment, and also availability of additional credit flow either through restructuring or otherwise. So that way it fits into the grand plan for revival of MSME or continued growth of MSMEs. That is one. The second aspect for MSME is, of course, the demand generation. That is where the Atmanirbhar related policy measures which the government has announced, and that should be by target, because that is targeting more and more of support for MSME in terms of orders and demand. That should help them out the second. And as and when the unlockdown happens across the country, the supply chain related problems can also be eased. So that way, within that grand plan, the liquidity and credit to flow, that is the role of the central bank, and that has been ensured through this announcement. So it gives a constant, confidence to this entire sector that you don't worry about liquidity, you don't worry about the credit being available. Now you concentrate on building your customer base and enhancing your productivity, and then go ahead on that basis.
Let me also take it across with Mr. R. Shivakumar. Mr. Shivakumar, hi, good evening. This is Ruchi Bhatia. Your first take on the RBI policy, and of course the comments coming in by the RBI Governor Shaktikanta Das as well, where he did say that even the liquidity flows in the mutual fund arena have also stabilized quite a bit after all the interventions that have been made post the Franklin Templeton issue as well.
Hi, good afternoon. And absolutely, I think this policy was quite measured in the sense that while they did not do anything in terms of rates, I think a lot of subtext in terms of support for the economy, and also obviously the steps in terms of restructuring of loans, etc. But it's very important the multiple references to capital markets and mutual funds in the policy statement. Firstly, in terms of course, what has happened over the past few months. Through RBI interventions, they have stabilized the debt markets, and obviously even the mutual funds have actually seen flows come back, and I think that's very important. But I think the larger piece comes from a couple of other statements. First, that the capital charge on debt mutual funds will be harmonized with bonds. This should make inflows and outflows from banks into mutual funds a lot more stable, and that will lead to a significant drop in volatility in debt corpuses in mutual funds, and therefore contribute to stability to markets. Second is the fact that he's again alluded to the overarching theme that OMOs of the RBI are aimed to reducing borrowing costs for the private sector. And I think the fact that the RBI is mindful of AAA to BBB borrowing costs when they are doing open market operations is something I think very, very important for the debt markets and debt mutual funds.
Right. Also, this one-time loan recast also coming in. How important do you think a measure like this is going to be, even though there's going to be a committee that will be looking into the modalities, and as Maithili was saying, we expect the banks to be much more nimble on their feet during times like these. But I want to understand from you, how important do you think a one-time restructuring process is going to be during times like these of extreme stress? In fact, even the RBI is expecting that if things were to worsen, the gross NPAs in the banking system may go up to 14% level. So a one-time restructuring scheme finally coming in, how effective and how important a step like this is going to be during these times?
Yeah, I think it is important, because when you look at the restructuring, they have allowed 2-3 different types of restructuring. One is for the corporate accounts with all these safeguards. The second is extending the MSME provisions, and of course also for personal loans. So this is the first time, one of the first times that you are seeing the RBI actually coming out and talking about personal loan restructuring also. So basically they are going all out in terms of allowing restructuring in the wake of this pandemic. So that's the first aspect, and I think it's very important. The reality is that a restructuring, because as a response to the pandemic, is fair. But I think what the governor was trying to say is they don't want to make this open-ended. Given the impact of the restructuring the last time around, I mean, we are talking about the period from 2009-2010, when there was a significant restructuring allowed, but that in some way many people believe contributed to the NPA cycle post-2012. So a lot of restructured accounts in 2009-2010 eventually became the NPA problem post-2012. I think RBI definitely wants to avoid that recurring, and that's why they want to put certain safeguards in place to make sure that the banks are not going willy-nilly into this or shut-eyed into this, and taking care and putting some safeguards. And I think that is very important. Now, we'll of course have to wait and see what the expert committee will prescribe. But in the meantime, my expectation is that this step will be taken up by the banks and of course their clients.
Yeah, absolutely. We have Mr. Anand Sinha, the former RBI Deputy Governor, as well, joining in on the show. Mr. Sinha, afternoon. The fact that, there is now going to be room for restructuring for MSMEs, and that's a big relief for, the choked segment, if I can use that word, and also for banks.
Well, restructuring in any case was required because of the fact that after so much of moratorium, all the accumulated dues cannot be paid off on the due dates. So restructuring had to be done. Now, the restructuring that we are talking about, actually, to put it very clearly, the restructuring today being talked about is about the retention of asset quality. That is, a standard asset remains standard on restructuring, which is contrary to the existing rules. And the NPAs on restructuring, they retain their classification, they are not downgraded. So restructuring, in any case, nobody has stopped banks from carrying out restructuring under 7 June circular. So this is really about retention of asset qualification. Asset quality. That is a standard account to remain standard. Now, RBI had to, obviously, in the light of the previous experience, be very careful in what does it entail. Now, I have had a quick look on the development and regulatory policy document, and this will be available to corporates who were standard as on March 1 to 2020, and they were not overdue for more than 30 days. That means they were not into SM1 or SM2 category. So this is an initial condition which ensures that these corporates were functioning prudently, were meeting their liabilities. The second thing which I would like to emphasize is that whether you call it restructured standard or whether you call it NPA, to my mind, apart from the fact that NPA has a very different connotation in India, otherwise, it does not matter much provided you back it up with solid provisioning. So even if you call it standard, but you realize that there is a much larger risk in restructuring, things could go wrong because after all, it's a forecast of how the company is going to behave, and there are so many imponderables. The economy may behave in a different way than what you assume. So if all these restructured accounts suddenly become NPAs, then that is where there is a problem. And let us also realize that the Indian banking system is not all that well capitalized. To give you some statistics on capitalization, there is a BIS very recent document which says that they had carried out a survey of about 5,600 banks in 141 countries, and their their CET1, that is Common Equity Tier 1 capital ratio, was 14%, whereas in India, our CET1 ratio, as given in the Financial Stability Report, is just about 11 point something. So we are far behind that, and therefore we don't really have the absorption capacity. So to guard against allowing a restructuring with retention of asset classification as standard, to my mind, it must be backed up by a heavy dose of provisioning. And I'm glad that the document says that there has to be a provision of 10%. Now, I would have been happier if 10% was a little higher, but it's okay. It's better than treating it as truly standard. And let me clarify in this context that even in the earlier regime, when accounts were retained as restructured standard accounts, the provisioning levels were higher. So I would say that restructuring was inevitable in the sense of going beyond June 7 circular. And there had to be many more safeguards going by the prior experience. And from the look of it, it looks that the safeguards have been built in. Number one, as I mentioned about the entry norms itself, backed up by higher level of provisioning. And of course, there will have to be some benchmarks. Now, many people argue that it should be left to the banks, but I would not agree with that because the job of the regulator is to create boundary conditions, and the idea is to create a boundary condition, and by using the expertise of the people in commercial field. So all in all, I think it's a good step.
Sure. Also, Mr. Gandhi, while policy space is available, the governor says, he's saying it must be used judiciously. From March, when he said that, we're going to do whatever it takes to try and instill growth back and fight the COVID-19 pandemic, since then we've seen 100 bips of rate cuts coming in. What indicators do you think that the MPC is going to monitor to try and ease rates further whenever it chooses to do?
Yeah, that has been a very, very constrained and balanced statement the MPC has done, in the sense that while they indicated that there is room for further rate actions, right now they are not doing it because their primary duty, statutory duty, is to look at the inflation and keep it within the limits. So since by the latest account on inflation, it is 6.1 as mentioned in the policy, which is slightly above the upper limit. And of course, everyone grants that this current period, it is not the real type of inflation, but still the MPC has its clear focus on inflation management. That is the reason they have not done any rate action now, even though from the growth perspective, there may be arguments in favor days and weeks, is how the inflation is figuring, how the headline inflation is figuring, and how other food and fuel inflation is figuring. Because these are the primary indicators which will give us a hint about whether there will be further policy actions or not. So that's why MPC will remain focused on inflation target.
Come to you with another sector, and that is the startups. The fact that startups will now get a part of the priority sector lending as well. How important is a step like this to push the Indian startups as well? Mr. Sinha, that question was for you.
Oh, I think that's a good step because startups need to be facilitated, and in that sense, I think it's a good step. And also because of the fact that the priority sector lending, with the rationalization which has happened, and also with the introduction of the certificate which can be bought and sold, the priority sector lending focus can be more diffuse, can be wider now at this point of time. And in that context, I think bringing in the new entities, the startups, is a good step.
Okay, all right. On that note, Mr. Sinha, Mr. Gandhi, as well as Mr. Shetty, always a pleasure chatting with you and getting in your perspective. With that, it's a wrap on this edition of the show. But big steps coming in by the RBI in the monetary policy, while they've kept an accommodative stance, have held a pause on rates, keeping a window open for any further rate action going forward. A big request that had come in by industry was that of a one-time restructuring scheme. Remember, it was a story that we got to you on the 25th of June. It has now been confirmed. Big relief coming in for industry as well as individuals as well. The RBI saying that they will be coming out with modalities very soon on the same. But with that, it's a wrap. Many thanks for watching.